So some of this demand will continue to come from conventional end uses. We don't discount that at all, but a significant contribution will be from energy transition sectors. You know, two key visible areas of demand growth will be the electric vehicles and the grid. I'm Angela, I'm from Wood Mackenzie. I'm very privileged to be invited back to actually face-to-face conference here at 121 for the first time in a couple of years. So that's, you know, a new normal. Hopefully that will continue on, you know, no more pandemics, hopefully. All right, so let's just see if we can drive this. So I think, you know, there's been a great deal of discussion on the space for metals, what is actually, you know, what is happening at the moment, and the drive towards electrification, decarbonisation. So certainly, you know, Wood Mackenzie is not alone in what we've been analysing over the last couple of years. So, you know, as a research group, we've been increasingly focused on these themes and what this means for the mining industry. So today we'll begin there. So what's driving the focus? So the slide here basically shows the increase in carbon emissions from fossil fuels over the last 50 years. We can see that emissions have continued to rise to the point where cumulative emissions reached around 1.3 trillion tonnes of CO2 equivalent tonnes at the end of 2021, resulting in about a 1.1 degree rise in average temperatures compared to pre-industrial levels. So the chart also shows where the growth in global emissions has come from, and this is really predominantly China, which is now the largest carbon emitter globally. Meanwhile, North America and Europe emissions have not declined materially, and this is really, they've just stayed roughly the same, and this is really largely to do with domestic or regional climate change policies. So we're aware that when emissions continue to rise, there is an impact on temperature as the capacity of ecosystems to absorb carbon decreases over time. So we see more heat waves, the flooding, and the impact of climate change on the environment, meaning that the global carbon budget is shrinking. To this end, many countries actually signed up to net zero targets at COP26 last year in Glasgow, but the world is currently not on track to meet those targets. So what would it take to meet the Paris Climate Change Agreement and the COP26 goals? So what we've done at Wood Mackenzie is come up with a scenario to demonstrate what is needed to achieve net zero by 2050. So the top line here we can see is basically emissions projected at a 2.5 to 2.7 degree warming, which is effectively the trajectory that we are on now. But if we follow the dark blue line down from 2025, this corresponds with the global net zero 2050 pathway. So the coloured section of the chart really represents all sectors of the economy that need to contribute to the reduction in emissions, whether it be power generation or transport electrification, the move towards green steel, and so on. It is in these sectors that will account for around 80% of carbon emission mitigation. But we expect carbon removal technologies, such as carbon capture, usage, and to play a really critical role in the overall abatement of carbon emissions, accounting for around 25% of the solution by 2050. We need to build carbon removal capacity at a rate that's actually significantly faster than we intend to reduce fossil fuel consumption. In effect, we need to focus on adaptation rather than mitigation. What is interesting to note here is that during the pandemic, emissions actually came down. So that is basically highlighted by the 2022. You can see the blip down in the blue line. So what we expect, however, with the onset of the Ukraine and Russian war is that this will actually start to increase again, given the basically the reactivation of coal-fired power in Europe as countries basically look to obviously shore up supplies, given that gas prices are now so high, and the move actually just generally away from Russian gas altogether. So getting back to the energy transition, electrification is undoubtedly a prime mover or a key enabler, and lowering the need or dependence of fossil fuels. Electrification means that the demand for hydrocarbons and fossil fuels will decline and emissions will ultimately fall. It also drives a lot of opportunities in mining and metals space, which is obviously what we're all gathered here to talk about today. And I will get onto the nickel story shortly. Our current projections indicate that electrification could see power demand grow by 3 times from the current levels to about 70,000 terawatt hours, which in turn will drive renewables growth. Battery demand grows by about 8 times from current levels, and solar and wind capacity grows also by 8 times from current levels. EV stock, our projections are currently that grow to 1 billion by 2050 from about 25 million in 2021. So that's a 40-fold increase from today's levels. So these numbers in terms of demand are staggering and will create significant investment opportunities for mining companies. We estimate that up to 60 trillion in investment will be required in the resources sector for an accelerated energy transition of 1.5 degree scenario. So mining companies have a major role to play in driving electrification needs and the move to net zero by 2050. So through this slide, we can see that the scale of the opportunity, some of the most vital energy transition metals, namely copper, aluminium and nickel. And basically we can see here that we were looking at basically a doubling of the size, or almost a doubling of the size of the copper market out to 2050, also a doubling of the aluminium market. And in terms of nickel, we would see it increase by about 3 times of current levels down in 2020. So some of this demand will continue to come from conventional end uses. We don't discount that at all, but a significant contribution will be from energy transition sectors. 2 key visible areas of demand growth will be the electric vehicles and the grid. The grid and energy storage systems will be required to support greater electrification and use of low carbon energy generation sources. As electricity output increases more aggressively under an AET 1.5 degree world, grid infrastructure will need to expand to cater to the demands of an increasingly electrified planet. Aluminium and copper play a prominent role here given their credibility as conductors of electricity, but additional transmission and distribution build-out would use more cables and wires to transmit electricity from the point of generation and distribute it to end consumers. We will also require more stationary energy storage, as I've alluded to before, to stabilise the grid as the penetration of variable energy storage increases in the power mix. This, in addition to EVs, will support demand for battery raw materials, and this includes not just nickel, but also copper, aluminium, which are used as current collectors and racking materials for energy storage units. On the EV front, more metals will be consumed in batteries as EV penetration increases, but more metal will be consumed in the rest of the vehicle to support structural modifications. For instance, compared to a conventional ICE vehicle, in an EV you will find more copper being in the form of copper foil in EV batteries besides the wiring. And the light weighting of vehicle requirements will require more aluminium use. So for nickel, it is really the battery-based applications which will drive future demand. With a greater penetration of some of the more, metals-intensive energy transition applications such as wind and solar, or battery-based applications such as EVs and stationary energy storage, metals demand is bound to witness a real step change. But here is also the challenge, which I think we've all been talking about certainly today and yesterday. If supply of those metals fails to keep a pace with such demand requirements, this can delay or derail those energy transition objectives. So how well placed are we able to provide this metal? So, currently there isn't enough supply. We're all, I think, agreed on that. On the chart, we can see that the higher percentage above all the bars means that greater need for material from these metals, even discounting scrap. Based on how we see the base case production profile, there isn't enough supply available to even meet our base case demand projections currently. This slide essentially showcases the scale of this challenge. A higher positive percentage on the bars in this graph indicates a greater supply gap as a proportion of the base case market supply, in turn highlighting the greater need for investment. As is apparent here, for some of these metals such as copper and zinc, the supply-demand gap for mined output is notable, even under the base case. We can't say that this will definitely be the shortfall because supply may come through because supply may come through or, demand may not grow as aggressively. But this is what it's looking like theoretically based on our current understanding over the next 10 years. If we move to the more aggressive 1.5 scenario, demand prospects that we just discussed imply a greater requirement for refined and mined metal compared to the base case. Even out discounting for higher use of scrap and secondary materials, the additional requirements for mined output are considerable. For copper, as an example, focusing on the medium term, the percentage of supply-demand gap for mined metal as a proportion of base case production capabilities widens by 8% in 2030 to 31% under an AET 1.5 scenario, while demand for refined metal grows by 31% compared to this year. So these theoretical gaps, again, theoretical, will only amplify as demand grows out to 2050 under an AET 1.5 scenario. That will be the case, especially for metals like copper, where demand is also being driven by urbanisation and population growth, as well as decarbonisation. The scale of this gap is particularly striking for lithium, as has been discussed yesterday. At over 1 million tonnes, the supply-demand gap in 2030 under an AET 1.5 is actually bigger than the current market size. So it's just truly astonishing. Yeah. Yeah.
So just a question about the cumulative demand. So there's obviously, batteries only have a certain lifetime.
Yes.
So, basically, if they're going to only last a dozen years or so,
yep.
So then you've just got this rolling problem that's going to continue also, isn't it?
No, you're absolutely right. But I think, what we can basically say about batteries and hopefully the transition of batteries into secondary purposing. So if we look at your electric vehicle, you would hope that eventually after maybe a 10-year life on the road that you can use it maybe in your home as a secondary storage unit. So by the time it actually hits a recycling path where we can actually extract that material back in to create new batteries, recycling, certainly for nickel, will become a greater part of the supply chain, which was never really the case. You see obviously secondary lead, recycling in copper, recycling in other materials, but certainly for nickel, that hasn't been quite as prevalent, but we do expect that to be a bigger part going forward. Certainly, yeah. Any other questions until I go on? I realise I just wanted to really set the scene, where we're coming from with our energy transition. So if we just go into nickel, basically this is just our supply-demand balance, and what, the green line is effectively our current sort of base case. And then if you look at the yellow line out to 2050, you're effectively looking at our supply demand or our consumption that is required on a 1.5 degree scenario. So at 2030, you would look at, it will be 1.1 million tonnes under the AET 1.5, and that would go out to 2.8 million tonnes by 2050. So it really is quite the ramp up in terms of nickel. And certainly, we just have not seen, despite a period of very high prices, we really haven't seen the investment back into this sector. And so that is, a huge challenge in this regard. So where, will all of this new capacity come from? So it is obviously hard to know, but in terms of our probable and possible projects, we have basically 4 million tonnes of identified production capability out there. We expect, as has been the case over this last little while, that future supply will come from Indonesia. They are majoritively, obviously, the largest producer in the world currently, and that their uptick was basically 470 kilotonnes out to 1.3 million tonnes by, we would be looking at those two from probable and possible projects. So that will be funded effectively by Chinese investment in Indonesia, has been the case over this last, I suppose, 10-year period. Chinese developments would predominantly require nickel to be sourced ex-China as direct shipping ore from the Philippines, and you would also look at Australia, the traditional sulfide sectors, as having significant potential. Those projects where a proposed product has been identified at over 70% will be as intermediate, so in the form of MHP, MSP, and sulfates, and all destined for the battery sector. And while Indonesia and China dominate, the ESG and carbon cost implementation will provide additional hurdles. I mean, this is simply because most of the material that has come out of Indonesia is all through nickel pig iron or matte smelting, so extremely high emitters of carbon as a result. So while China and Indonesia are the largest producers of nickel, they're also the largest producers of CO2. So that is something that's going to have to be grappled with, certainly as ESG concerns become front and centre of investment choices for governments and investors alike. Hello.
The difference between some of the nickels, like massive sulfides and nickel laterites.
Yes.
Sorry. Difference between the two types of nickels, nickel sulfides and laterites.
Yep.
Does that have a bigger impact because it's a nickel laterite, the CO2 and the costs as well?
Yeah. So if you look at your typical, so effectively the way we talk about nickel, and pardon me if everybody already knows this, so we would say that the sulfides are generally smelted. Okay, they're also generally underground operations. So the CO2 emissions that come out of your general underground mine and also through the smelting of sulfides, it's just a smaller scale than what is happening, say, with laterites, which are all open pit operations, and they're all thermal coal required in order to smelt your laterite, your average laterite in Indonesia or the Philippines or New Caledonia, let's say. So yes, and I actually have, that just takes me to the following chart. So you can see here average emissions by nickel process. So if you look at here, MPI, electric arc furnace, which is predominantly produced in Indonesia, and then you look at ferronickel, also produced in Indonesia, but also in the Western world, and then you'd have MPI RKEF. You can see that these are the higher emitters. There's no nickel pig iron blast furnace in Indonesia anymore, but that still is occurring in China. So they are your differences. Also, the other issue around Indonesian production of nickel pig iron is actually no, more from a HPAL perspective, is that you've also got the waste that is generated from your average HPAL plant. So that is also an issue. So you might have high CO2 on one side of the equation when you're creating nickel pig iron for smelting and for the stainless sector, but when you're creating nickel for the battery sector, you're also going to have a large waste profile. So in an environment like Indonesia, you can't really cope with such a huge amount of tailings. So the dry stacking process really has to come forward, because for every tonne of nickel that you are producing, you're going to basically bring forward 1.4 tonnes of waste. So that needs to be dealt with. And again, as we've talked about, our electric vehicles in Queensland, and they're coming off of coal-fired power, we also don't want the battery that we're using in our electric vehicle coming from nickel that has, in Indonesia, that has basically pumped its tailings into the sea. So I think, as consumers, we're all becoming more and more educated in terms of where those materials are coming from, so that we are part of the whole supply chain. And I think, there's plenty of companies now, and BHP is certainly one that is looking to try and trace its nickel from source to end, so that at the end of its life, at the end of its battery life, it can somehow capture it back and then bring it back to a recycling centre so that it can repurpose it and use it again. Yeah, cool. Okay. Sorry, I'm completely off-piste now. But anyway, so I think what we also wanted to talk about is carbon taxes. We've just created a tool at Wood Mackenzie where we can add a blanket carbon tax onto all of the industries that we cover in terms of the LME metals. So in this situation, a blanket carbon tax of, say, US $100 per tonne or CO2 emission tonne would increase the average cost of production by around $3,800 per tonne of nickel. So where prices actually sit at the moment, I mean, the industry is quite healthy. Most companies are making margin. So the addition of a carbon tax we don't see as a game changer, and we think that, you know, companies are generally moving towards the idea that this will be introduced in certain jurisdictions, and it is, you know, a foregone conclusion that, you know, carbon taxation is the next thing on the horizon. And I think the gold producer that was here yesterday certainly highlighted that that's happening in British Columbia. We just expect that will continue, you know, certainly for this industry, which is such a high emitter, and you know, and it's such an energy intensive industry. And so nickel production will be, you know, subject to decarb targets, and this is really just showing over time what this looks like, how it would be, you know, at current levels, but what this would actually increase to by out to 2040. So it will cost currently base case supply of about $14 billion a year in carbon taxes to meet zero emissions, and this is 3.5 times the cost to the copper mining industry, which is also 10 times the size of the nickel industry. So it's quite an interesting juxtaposition when you compare nickel and copper in that regard. And so if we just look at it over the long-term price, we would think that base case long-term price, for, you know, based on C2 costs, is around $18,360 per tonne. And with the implementation of carbon costs, we would basically require the price to end up at around $22,500 per tonne. So in recent history, this has occurred. You know, we have been sitting around that, you know, $20,000 per tonne level. Obviously, we had quite an insult to the market at the start of the year with the Tsingshan short position happening, but we've come back to fairly standard levels. I think, you know, what we really need to highlight with nickel is that we have had high prices for quite a long time historically, and we still don't see the investment in the market. And that's challenging. That's extremely challenging. Again, like most other commodities, you find projects are in difficult jurisdictions. There are risks that overhang many of these projects, and they're just not getting developed. So for as long as I've been looking at nickel for some time now, you know, there's very few new projects that come forward. I mean, even here in Australia with the Western Areas IGO changeover this year, Western Areas were going to bring on Odysseus this year, but IGO have actually now delayed that. So we see, you know, and they're all just replacement tons. It's not as though it's a whole heap of new material coming forward. So yeah, we definitely see a real need for more units. That's for sure. Why is it delayed? I think that's just really to do with scope. I think as IGO have come into it, they actually just want to widen the scope of the project, whereas I think probably with Western Areas it was fairly hard and fast. We're going to just go down this path. But I think given the transition of Nova, you know, coming to end of life and then them transitioning over to Odysseus, I think they just want to, you know, dot the I's and cross the T's more than anything. I don't think there's any hurdle that I understand of that is delaying it, rather than just a little bit more due diligence. Well, the thing is, there's been a lack of new projects for a very long time. So I don't believe that's actually the case. I mean, Indonesia did so well because China decided we can't have it in our backyard. Well, no, not that we can't have it in our backyard. The power costs were so much cheaper in Indonesia, and that's why they basically built their industrial parks in Indonesia, and obviously with the support of the Indonesian government. So that was just a really great way to move forward. They were able to, you know, accelerate there in an unprecedented fashion, you know, something that probably can't happen in the West, in Western Australia, you know, in more traditional centres of sulphide mining, that's for sure.
So
Sorry, can I just ask a question there as well? Sorry, I'm here.
Yep. So so hard. It comes from all directions.
Where there haven't been any projects developed, is the resource there for it? It just needs to be developed, or does the resource need to be found as well?
No, look, there's certainly, I mean, in our database, we would have, I would think, nearly some 300 different projects that have been around for a very long time, some new, some old. There's just generally some kind of hurdle that is preventing it from happening. There are projects out there. There are certainly projects there. It's just finding the right kind of backing. I mean, in HPAL, high pressure acid leach for laterite operations has had such a bad rap in terms of how it's moved forward. Like there was just monumental failures at Goro, at various other operations. So that's been very difficult. But if anybody can crack it, it's the Indonesians with Chinese investment. So at the moment, you see that what is happening in Indonesia is that because of emissions to a certain degree, they can bring back the amount of material that they're producing for the stainless sector, which is still 60% or 65% of a nickel demand, and look at the battery sector, which they see as the growth area. And just after traveling up there in June, I mean, they want to be able to, they've got all of the raw materials and they want to be able to get to the end where they're producing a battery for a scooter or a battery for an electric vehicle. And that, and LG and CATL have certainly already bought into that supply chain in Indonesia, and that is what they are absolutely supporting. So it's that whole connection of the supply chain that I think is, what many of the presenters have talked about, and who you need to speak to in order to tie up that offtake and how far you need to go. That you're talking to the auto company, you're not just talking to a concentrate offtake. Yeah. Yep. Any further questions? Sorry, very ad-lib.
Sorry, I know you're trying to carry on your presentation.
No, that's
just on that final comment on OEM acceptance.
Yep.
I think you're right that there's obviously a huge amount of potential for further growth in these markets, and I'll talk about it for cobalt later on.
Yes,
it's all coming from the same place. But a concern for me and others is, will the OEMs actually accept that in the West? Or is it all just destined for China? And I don't know, have you looked at your supply-demand balance for nickel, kind of assuming that doesn't go to Western OEMs, and kind of where does the supply come from otherwise?
It's a good question.
You might not have the answer, I don't, but I'm just interested.
Look, I do think it's a more... obviously a lot of, we could say that all of the nickel sulfate that we look at currently is all going to be processed in China. But I do think that will start to change. Many of the conferences that I've certainly attended recently are more about the lack of globalization with things. So trying to have those, I suppose, the gigafactory, the recycling, like everything happening in a much smaller space, because effectively your scope 3 emissions are the thing that you're starting to consider now. So look, I don't know of any of those contracts that are sort of, I suppose, outside of what I can see, certainly in Indonesia and China at the moment. But certainly Korea. There's other sectors or other countries that are certainly going down that path as well. But I think it's just getting more and more clarity around it. It's hard to know. It's hard to get information. And certainly, I'm sure you've probably tried. We've all tried to find out where BHP are trying to sell their nickel sulfate and what the specs are and things like that, but you can't get it. So, so I think it's very much a closed book, which is the way it's always been for nickel, to be honest. But, it's just starting to understand more of where that material can start to go and what the stipulations are in terms of, the purity of your average nickel cobalt sulfate. Yeah.
Angela, sorry.
No, that's fine. No, don't apologise.
Just on a similar path, do you think ultimately there'll be different pricing for nickel sulfite sourced versus laterite to reflect that carbon impact, or do you think that gets captured by a carbon price?
Look, I think that that could definitely happen. I mean, if you are the greater emitter, you should be paying more of the tax, and if you're less of an emitter, you shouldn't be paying as much. So yes, there might be some advantage to Western. Because basically it's Canada and Australia effectively. I mean, Russia obviously sits there as well, but we could say that all the Russian material will be going to China from here on in. So, until there's an eventuation there, yes, I think, those sulfide producers could potentially benefit from well, they will benefit from lower CO2. And then you look at somewhere like Indonesia, who will basically be trying to work out what can we do to minimize the CO2, and they are doing that now with the transition of nickel pig iron lines over to matte lines in order to produce an MSP, in order to put that towards nickel sulfate and battery precursor material. So they're mixing it up so that they I suppose they're hedging their bets in that regard, so that they can basically play to two masters, the battery sector and the stainless steel sector. Yep. Cool. All right. I don't know where I am with this anymore. So just in terms of nickel projects, I mean, what we're really just looking at here is the emissions curve. And I think what is positive, obviously we can't see that there are a huge amount of projects in our database, but the ones that are identified here will actually have lower CO2 emissions than, what's the weighted average that we would calculate for today. So that is a good sign. And I think that is certainly the way forward, is that most projects that are developed will be lower CO2 emitters than the big industrial parks that we would see in Indonesia. But like I said, they're diversifying as we speak, and I would suggest that they would be, we believe that they're mixing it up in such a way that they will lower that CO2 footprint. And just to summarise, so under our base case, our outlook, we've got an additional 1.3 million tonnes of nickel that's required, but this would actually increase to 2.8 million tonnes under an AET 1.5 scenario. Indonesia will be key to providing new nickel production here as well as everywhere. This must be done with a view to sustainable development and not just focusing on emissions. And the implementation of a carbon costs must lead to higher nickel prices. And the current expectations, as I've just said, would raise our long-term price from around $18,360 up to $22,500 per tonne. And if there's any more questions, I'm here for them. But otherwise, that's me in a nutshell. Thank you. You did have a question?
Yeah, just the same question as always. Where is the funding going to come from all this for this? What is your opinion about where this funds and the capital efficiency is going to come from? So particularly Australia and obviously nearby countries. Yeah. Well, China and Indonesia, we understand that. What about here?
Here is difficult. Here is particularly difficult. I think what has happened, I mean, say with BHP and Nickel West, obviously it was spun out of the core group, then brought back in as part of the energy transition. We have to look at some of these bigger players that have deeper pockets and obviously a diversified portfolio in order to, support future exploration. I think that's really how it works. And then you look at companies like IGO, diversifying into lithium. You've got to basically get the whole battery suite in your inventory, I think, in a way, and try and take from Peter in order to give to Paul. I think that's the only way it can really, really work. You see a lot of groups that have just been pure nickel plays, and it's been difficult. Black Mountain have been around, say, in Australia for quite a while, and nothing's really happened. You look at certain groups and they just haven't been able to get any traction, whereas a project has been there. So I don't know what the final answer is, because you would think a lot of it is fairly straightforward. And if you're not looking at a complex, large-scale HPAL, a simple sulfide mine to operate shouldn't be, mind-blowing. But it's not there. So I don't know what investors are really looking for in that regard. But it's interesting, and obviously the requirement is there for the units. Thank you.